I thought we were going to go through, some of the things I looked at last year's slides that I presented to you all, and, I thought that there's some updates to those, and there's some interesting new projects on the agenda. So I want to get to all of those and, explain what's happening and where we're moving. And there's some like new information that we just found out this morning. So I'll give you all of that too. So on slide 3, if you could go to slide 3, the agenda, we'll talk about key developments and recently issued standards. We'll talk about the environmental monitoring, COVID-19. I might spend a little less time on that because that's a little bit old news. Implementation of recent standards, the agenda consultation that we've been working on that the FASB board has sent out to all stakeholders last year to get feedback on what our agenda should be and what we should prioritize and not prioritize. And then the last bullet is the research agenda and other current projects that are on the agenda. So we're going to move on to, let's see, we're going to skip over to slide 6. And these recent developments really aren't recent. It's like 2 years, I'd say. We probably have to, this slide's getting a little old. And we're going to talk about all of these things today, so I won't spend, again, a lot of time on this slide. We removed the one thing that we did highlight here, I wanted to highlight, is that the board removed the balance sheet classification of debt project from the FASB's agenda last year. I know this was a controversial project in some ways, I think more in healthcare than in higher ed. But, with the variable rate demand obligations, there really wasn't like a way forward with solutions for short-term and long-term debt. So the board just said, it's better to keep current GAAP than try to create like new complexities. So I'm going to move on to slide 7. I'll count ASU 2020-103, accounting alternative for evaluating triggering events. So this kind of came about sort of as a result of COVID. It's not really COVID related per se. The board, that what happened was that, you have to evaluate whether you amortize goodwill or not. You have to evaluate a triggering event based on the date that it occurs or the time that it occurs. So let's say March 2020 when COVID hit, and you would have to have information as of that date to perform the assessment. So many not-for-profits and private companies said, we don't really have that information available. And so the board amended that test, that a triggering event test, to say that you do that triggering event test when you're going to issue your financial statements. And that's regardless of whether you amortize or not. And so the triggering event would be done at the end of each reporting period. So everybody would have to do it for their annual period. And for those of you who have to do interim financial statements in accordance with GAAP, you would also have to do that then too, right? You would have to actually do the test for that interim financial statements. However, the guidance doesn't define what interim is, so you have to, you have to kind of, if you do GAAP compliant interim financial statements, and there's a project on the agenda right now looking at making sure that that's clear in GAAP, then you would have to do that test as of that date too. So it kind of brings it forward. The advantage is that you have information and that you're sort of presenting the information as of the balance sheet date. The conditions that prevail as of the balance sheet date. So you could argue that that's actually better information than doing the test as of some random date during the year. So that's for private companies and not-for-profits. Another standard that was issued late last year was the discount rate for lessees that are not public business entities. So some of you may have already implemented leases, and some will be implementing leases for this fiscal year. This accounting policy election was the original accounting policy election with the original Leases standard said that you could use a risk-free rate for all of your leases, but you had to do it for all of them. So it was an all or nothing. So there were some questions a couple of years ago in the low interest rate environment that is probably now ending, that, when you discount using a very low interest rate, you're going to be, you're going to getting high, potentially overvalued assets and liabilities. And so also the question came up, you have to use the rate implicit in the lease if it's readily determinable. So there were questions about which guidance overrides the other? Do you just use the blanket accounting policy election, or do you have to use the rate in the lease if you know it? So the board made several decisions here for entities that are not public business entities. So and so that the level of the accounting policy election, excuse me, is at the asset class basis. So you could do it by asset class basis. So you don't have to consider. You could focus maybe using an incremental borrowing rate for your bigger ticket items, and then, excuse me, everything's going wrong today. So use it for your bigger ticket items, and then use the risk-free rate for other leases. Excuse me. I don't know what's happening to me today. I'm just going to take a quick drink. And so the rate, and then the board said that if you know the rate implicit in the lease, if it's readily determinable, that overrides any accounting policy election. So for transition and effective date, the standard specifies that if you've already implemented leases, then you would do this as of your fiscal year beginning in 2022. And for leases, if you haven't adopted leases yet, then you would just kind of merge this in with your leases adoption. So I'm already on, I'm sorry, and I'm not telling you what slide I'm on. I apologize, because I'm assuming I usually do this at the same time. So I'm on slide 10. So, okay, so ASU 2021-10 on government assistance. This is not for non-for-profit entities. This is for business entities. So not-for-profit entities have guidance on point for government grants. You record government grants in accordance with 958-605 in GAAP, and so, but business entities don't have any guidance on point. And so there was a long-standing project, I think from early, like 2012, 14 timeframe, that was looking at accounting for government assistance and disclosures, and then the project kept getting sort of narrower and narrower over time. And what the board decided to do was kind of really narrow these disclosure requirements to focus on entities that analogize to 958-605 or IAS 20. So business entities don't have any gap for government grants. So very often they'll use the not-for-profit guidance, but more frequently we've heard that they use IAS 20. And there's a slide later on about the main differences between those two standards. So I'll focus on that a little bit later. So the reason that we bring it up for not-for-profits is that a lot of these disclosures are good disclosures and are kind of already in line with what some NFPs are doing. But they might be disclosures that you'd want to consider. So you talk about the nature of the transaction, your accounting policy. So did you choose 958-605 or did you choose IAS 20, which is IFRS, international guidance? And the line items on the financial statements that are affected by the grants, the amounts, and the terms and conditions, including commitments and contingencies on those. So again, we're just pointing this out. There is another project on accounting for government grants, which I'm going to get to at the end, I hope. I hope I have enough time. So we're going to have a polling question on slide 11, and again, I'm not going to be able to see the results, so maybe Alexa or someone there could kind of, digest this. But the first polling question is, what types of entities may apply the guidance in ASU 2021-03, accounting alternative for evaluating triggering events? A, private companies, B, not-for-profits, C, private companies and not-for-profits, or D, all entities. So I'll give you kind of a few minutes or a minute or so to answer that. Maybe Alexa, you could tell me when the results are in.
Jeff, we have some results in right now. 75% is all entities, 14% private companies and not-for-profits, 6% not-for-profits, and 4% private companies.
Okay, so all right, great. So the correct answer, I don't know if I should wait till you close out the poll.
You can go ahead.
Okay, the correct answer is C, private companies and not-for-profit. So other business entities, public companies still have to do the triggering event test on the date that it occurs. And the reason is that they are going to have more, resources to do that analysis. So I'm going to move on. Environmental monitoring, again, a lot of this stuff is older stuff that I've talked about previously. Accounting for lease concessions. This was issued a couple years ago to help with, the shutdown during COVID, and many entities like retail outlets that maybe had a lot of leases. If the concessions that were being granted because of COVID weren't contractual, that automatically threw you into the lease modification guidance, which is fairly complex. So if you had thousands of leases, then you had to go through this modification guidance for all of those leases. So this kind of gives you an out and says that as long as, if these concessions were granted as a result of COVID, you could just assume they were contractual and follow that guidance. Just assume that it's not a modification of the lease, as long as it doesn't increase substantially the rights of the lessor or the obligations of the lessee. So just that is there. But again, it has to be related to COVID-19, and probably is not as much of a big issue now. On the next slide, slide 14, we have other important FASB documents. And so this one, there's a paper out, an educational paper to help people with the debt modifications guidance, because many, private companies, smaller companies, maybe not-for-profits even, were dealing with, modifying debt arrangements, if you have programmatic loans or something like that. And so, and the guidance in Topic 470 is, it's pretty complicated. It's pretty, hard to follow. So I think this educational paper kind of lays it all out, lays out the most important guidance that might be the most relevant for these fact patterns that were occurring, and really walks you through U.S. GAAP on that. So it's educational in nature. There's nothing new, but it is a paper that, and I think you have the link there where you could download that if you have the link. And then there's a staff Q&A on hedge accounting, which I will not spend any time on. Hedge accounting was my prior life here at the FASB before I joined the not-for-profit team. But, if you have any questions on that, please feel free anytime to reach out to me. On slide 15, I'm going to remember to say the slide numbers. I'm not going to spend much time on this again, focus on some of the other projects that are coming up. But, there's a lot of things. This COVID-19 assistance is kind of winding down in some ways, and I know there's a couple questions still out there about some of it. And so this kind of summarizes all of that guidance. There are links to the AICPA TQAs out there, which are very helpful, which the FASB staff also consults on. We don't write them, but we definitely review and consult on those. The NACUBO tutorials you're probably all familiar with about how to record the higher education emergency relief funds, the various tranches of those, and whether you need to link the university portion to the student portion or not. And so that new NACUBO tutorial's out there. There's one on employee retention. The one that I wanted to just spend a few minutes, or a minute on at least, is the employee retention credits. So they are, as you know, for payroll taxes, to get reimbursements for payroll taxes. You couldn't double dip, so if you were getting PPP loans for those or PPP assistance with those, you couldn't double dip the same expenses. We called it, I think that's Jeff Mechanic's term, double dipping. But you can't get a grant for the same expenses. But if you have new or different expenses related to employee payroll taxes, then of course you could apply for the employee retention credits for those. So the question was, how do you account for those grants? How do you account for those? Well, I gave away the answer. I just said grants, right? So people asked if you could net it against payroll taxes, and the answer to that is no. First of all, it's not an income tax, right? It's not ASC 740. This is not an income tax. These are payroll taxes, and asked whether you could net it or not. So, the staff view, and again, everything is my opinion today, everything I say. My opinion is that these are grants, right? So you cannot net them against the payroll taxes. And then I know there's a whole host of questions related to like prior period. So like if you applied in the current, like this year to get ERCs for a prior year, there's a whole host of questions about how do you account for those. And I was just at the AICPA conference in Washington. There, we talked a lot about this. Some of the firms that were presenting, and as well as us, said, that we feel, this is our opinion again, that these are government grants. They're current. You have to apply for these grants. It's not an entitlement. So the act of apply doesn't mean that you have to go back and reopen financial statements. There are some other considerations that this Journal of Accountancy article, if you see the link on the slide, kind of goes through. There was the Center for Plain English Accounting put out some guidance, potential guidance on this, and said that this was talked about using a loss recovery model. However, the staff didn't review that or approve, not approve, but we didn't review that article. But the Journal of Accountancy article is really good, and there's a link to it, and kind of walks through all the considerations, things that you might want to consider for your prior period grant, prior period amounts or current period amounts, how you should account for them. So on slide 16, I'm going to move to slide 17. And I'll sort of focus just a little bit. I won't go through all three slides here in detail for time. So ASU 2020-04 and reference rate reform is, basically LIBOR and all the interbank offering rates going away. And so that's because of the LIBOR fixing scandals back like 10 years ago now. And LIBOR rates are not really linked always to actual transactions. So all the different countries' banking regulators went in to look at, what new rates we could have. And so in the U.S., one of the rates that's been kind of blessed by a consortium of the largest banks is the secured overnight financing rate, which is linked to trillions of dollars of actual repo transactions. And so, LIBOR is being phased out. And the original phase out date was December 31st, 2021. And of course, when anything like this happens, there's always accounting problems, right? So the issue here is that you have like debt modification issues. So you have to, it's a very complex guidance if you have to determine about each debt instrument, whether it was a modification of the existing debt or an extinguishment and an issuance of the new debt. There's the whole test you have to go through. So for the large financial institutions, this was a big problem. And so to go through this instrument by instrument. So ASU 2020-04 kind of gives you relief, right? It gives you temporary relief from having to go through that complicated test. And it says that you could assume that as long as the reference rate changes from LIBOR to another rate, that and other things that are related to the rate, like the reset dates or the payment dates change, then you could assume that the modification is not an extinguishment, it's just a continuation of your debt, basically just calculated into effective interest rate. So, and there are some other changes to that. However, kind of the wrinkle on slide 18 is that, so the original date was supposed to be December 31st, 2021, that LIBOR was going away. So this topic 848, which is a new topic that was brought about by ASU 2020-04, gave you a whole year to kind of get your house in order, to get yourself onto the new, interest rate. And so it's like temporary, it's like long-term transition guidance, right? You have a whole year to get your house in order. If you have any hedges, adjust your hedging relationships accordingly. Kind of gives you an out for hedging as well, which I won't go into. However, the problem is that LIBOR isn't going away on December. It didn't go away on December 31st, 2021. It's been extended. Certain tenors of USD LIBOR are now going to June 30th, 2023. So that leaves a problem for the accounting standard, because the accounting standard ends on December 31st, 2022. So there's an exposure draft out there to extend the sunset date, as we call it the sunset date, the date that this relief expires. And so when the relief expires, you have to go back to regular GAAP, right, and apply this complex, modifications testing. So the proposal out there is to extend this relief until December 31st, 2024. And then, the board is going to meet pretty soon, I think, to discuss that. I don't see that I think it will happen. I mean, I don't, it's my opinion, but I'm pretty sure that this is going to happen. But just as reminders for not-for-profits is to, review your contracts and agreements, see if there's LIBOR and another rate in there that's going away, talk to your creditor or lender, and consider this transition guidance because it is very helpful and very useful. And you probably don't want to go through all those complicated tests if you don't have to. So this kind of gives you that out. And you have some time. Again, this will probably be extended to December 31st, 2024. But again, that's my opinion. So I'm going to move on. I think I'm on, the slide numbers might be off. And for me, it's effective dates for NFPs. Is that slide 20? I don't know. So I just want to make sure I'm not giving you the wrong slide number. So it's the one that says effective dates for NFPs. Just as a reminder that there are several effective dates, coming up. So now gifts in kind or contributions to non-financial assets should be effective for fiscal years that are ending, ending for June 30th, 2022 for sure, and any calendar year financial statements also are going to be affected by that disclosure standard and presentation. Leases, in higher education, probably a lot of higher education's already implemented leases, but for fiscal year 2020. But anybody else, any other NFPs have to implement it for this fiscal year beginning in 2022. And we'll talk about transition. And then credit losses, which is a big standard coming up. That's going to be effective, in fiscal years beginning in 2023. So I'm going to sort of dive in. The next slide that says accounting standards updates effective dates is just there's a link here, a useful link for you to click on, and you could see all the effective dates that may or may not be applicable to you. So that's kind of more of an informational. And now I'm going to go to the slide that says update 2020-07. Objective and scope. And so I know in the higher education space, there's not a lot of gifts in kind or contributed non-financial assets, but I just want to point out that if anybody is and I know this is kind of a hot topic right now, if you're getting donated cryptocurrency, that is a non-financial asset. And we'll get to that in a later slide. But it is a non-financial asset. So if you receive material donation of cryptocurrency, you may have to apply the guidance in ASU 2020-07. And so the whole purpose of the gifts in kind standard was to increase transparency about contributed non-financial assets, because in some non-for-profits, that could be a substantial portion of their contributions. And it could affect ratios, your program expense ratios. If you didn't get enough contributions in non-financial assets, you might have to go out and purchase those. So there's a lot of good information here. And so the scope is all non-financial assets. So anything, basically the gap definition of anything that's not a financial asset is by default a non-financial asset. So it's like the residual definition. So anything like if you got fixed assets, the use of fixed assets, that is leases, intangibles, or contributed services that have to be recognized in your statement of activities, those are all non-financial assets. And again, cryptocurrency. And we're going to spend a little time on that, hopefully later on here in the slide deck. So the requirements on the next slide of 2020-07 is you have to present contributed non-financial assets as a separate line of the financial statement in the statement of activities, apart from contributions of cash or other income financial assets. And then in a footnote, you have to disaggregate by category of non-financial asset those that you've received, your policy, whether you monetize those, whether there are any restrictions, and how they were valued. So again, if you receive a contribution of crypto, you might have to apply these requirements. And on the next slide, contributed services disclosure requirements. Again, ASU 2020-07 didn't change any U.S. GAAP related to previous disclosure requirements. So if you received contributed services that you would have to recognize in your financial statements, like legal, accounting, medical, consultation that you would ordinarily have to pay for, that you have to record in your financial statements, those disclosure requirements still exist. Other disclosure requirements like your number of volunteer hours, et cetera, all those requirements stay the same. So ASU 2020-07 is just on top of what's already out there. And again, if you receive, contributed leases, those are non-financial assets as well. So now I'm on the slide Update 2020-07 FAQs. And so I'm going to go through this, I'm just going to focus really on 2 and 3. Again, cryptocurrency is something you have to consider. So I've kind of already answered that one. And then the expenses that are funded by GICs, do you have to present those separately? So essentially you only have to disclose the contribution of the non-financial asset and not the expense related to it. However, you could choose to do so if you want to. You just don't have to present it. And there are several reasons for not requiring that, mostly that NFP systems generally don't track the expense side as well. They don't track whether a non-financial asset was purchased versus donated. However, you may choose to do so. And I'll go through the next few slides kind of quickly as well. So again, on the slide that says GIG presentation separate line, again, this is the presentation. If you receive a gift in kind or that is a non-financial asset, you do have to present it as a separate line, separate from your contributions of financial assets. So this is one acceptable presentation. And then on the next slide, the one that says separate column, you may choose, if you get significant non-financial assets, you may choose to present it as a separate column. And then the line item that says like animal shelter expenses, that's, again, expenses are not required to be disclosed. So you may choose not to do this presentation. And then the one that talks about raffles and other direct donor benefits. We've gotten a lot of questions about how to present like raffle item. If someone donates a car to you and you're going to raffle it off or in a silent auction, there are various presentation alternatives, and we just wanted to show some of those. So here we have like the in-kind revenues. Let's say you received a $10 contribution, an item that was worth $10, and you sold $25 in raffle tickets. So you could show the special events revenue and the in-kind revenue together, and then the expense related to the distribution of the non-financial asset to the winner. It could be in your fundraising expenses, because again, you don't have to show expenses separately. Or on the next slide, you could show the direct donor benefit again within special events revenue. So there's a lot of different presentation alternatives, but the main message here is that contributions of non-financial assets have to be presented and disclosed separately, unless they're immaterial. That was one of the questions. If they're not material, if you got, someone gave you a $10 gift card or something or whatever, it's not, or a book, and it's really, really immaterial to financial statements. Obviously, you don't have to disclose those. And now I'm on the slide Leases transition method. So for those of you who've already transitioned to Leases, you don't have to listen. But if you're going to transition to Leases, then you have 2 choices in how you make that presentation. So the original ASU 2016-02 said that you had to show all periods presented under the new Leases guidance. And so let's say you adopted, 1/1/21, right? 1/1/22 is your year of adoption. You have to go back and show your prior years under the new guidance as well and make that cumulative adjustment as of 1/1/21. But, whenever your fiscal year begins. However, there's optional relief to do that adjustment as of the date that you adopt the standard. So if you're going to adopt on 1/1/22, your beginning of your fiscal year, then you could make that adjustment on the beginning of the year, and then you just leave your prior periods as is, and you just don't worry about them. For discount rates, you could use the discount rate in place as of the date of adoption, so 1/1/22 in this example. And then for period of the lease, so let's say you're like 4 years into a 10-year lease on 1/1/22. Do you use use all rates that prevail on 1/1/22? However, do you use a 4-year term, or do you use a 6-year remaining term, or do you use a 10-year original term? And so there's no guidance in Topic 842 on what to do. I did some research and looked at some of the firm guides, and some of them say that what you would do is you would make an accounting policy decision to either use the original term of the lease or the remaining term. However, you have to be consistent. You can't cherry pick and say, I'll do original term for this and remaining term for that one. that lease. So just some information here if you're still in that position of having to modify leases. But from what I've heard from the NACUBO conference that I was at in April, like leases is not such a big deal in higher ed. But again, if you have any questions, you could always feel free to reach out to us here at the FASB, and we can help you. One of the questions on leases that we always get is like, what if it's for $0? And the answer to that, the quick answer to that is, if it's for $0, it's not a lease. Or if it's like, and this is our interpretation as a staff, it's like $1 a year, where it's really just a symbolic amount. There's no consideration in the contract. And in order for you to have a lease, you have to have consideration in the contract. So you're probably in a contribution model here. Or if you get a lease for way below, consideration, below market consideration, you might have to consider not only the leases guidance, but also like the inherent contribution guidance as well. That's just a little FYI. There's an AICPA paper that was put out a few years ago that kind of walks through this, and I found it personally very helpful. So, I would just recommend, finding that paper that was written a while back on this. It's very, very helpful if this is something that you're facing. Lessee Disclosures, just a quick, there are lots of new disclosures if you're implementing this, but just at a high level, rather than going through all of these, is that you want to provide your users with qualitative and quantitative information about your leases. Again, financing and operating leases are still around. What were the significant judgments that you used, and what are the amounts in the financial statements, and where are they? And you're going to look at like your lease payments maturity analysis, similar to what you already did under old GAAP, is still a disclosure requirement. So you don't get out of that one. So on the next slide about current expected credit losses, just want to give you a heads up. As you know, 2020 fiscal years, that begin in 2023, you're going to have to implement credit losses, and it applies to everybody. And so just as, a reminder that, what's in scope and what's out of scope. So loans, trade receivables, student receivables, for example, are in scope. And so, just as a heads up about that. And the difference, and we'll get to the next slide in a minute, but contributions and pledges receivable are actually not in scope. And the reason for that is because they're not, there's no credit associated with that contribution, right? So this is a credit losses standard. And so your contributions are not in scope, and most grants receivable, they're not in that model. So that's one good thing. However, if you have loans, on the next slide, what CECL, the whole point of CECL is to move from booking a loss when it was probable to day one. And so, you start with your historical losses, you adjust them for current conditions and reasonable forecasts, and then you revert back to history after a certain point. So I'm going to skip over to the next slide about the effect for student receivables and patient receivables for hospitals. Basically, you're probably aging your receivables, you're looking at your history, and that's all good. The main difference is you're going to have to look at booking this on day one. Considering your current conditions, you're going to have to look at the future, estimates of the future. And again, once your estimates of the future, once you can't project anymore, you go back to your historical assumptions. And there's going to be some additional disclosures here. And I know the AICPA NFP expert panel is looking at some stuff here regarding programmatic loans, which probably doesn't apply, to higher education. So we're going to go to polling question number 2. And so it's a true or false question. Under ASU 2020-07, expenses related to contributed non-financial assets do not need to be separately presented in the statement of activities, but an NFP may choose to present them separately. So A is true and B is false. And so I want to kind of get to, even if I could have a couple more minutes, get to some of the new projects. I'm going to try, I might skip over a few slides because I really want to focus on some of our new projects and some of the latest news. But yeah, Alexa, let me know when that's all done.
Jeff, we're at 76% true and 24% false.
Okay, sounds good. Well, 76% of you got it right then, because you don't have to present them separately. So, all right, I'm going to keep going just for the sake of time. I'm going to I'll just focus on the first slide here that says agenda consultation, invitation to comment. I'm not going to go through. I'll kind of summarize this a bit more quickly than I usually do. But we sent out an invitation to comment on June last year, and I think our speech, my presentation to you was at the beginning of June. So this was at the end of June, and then there was an invitation to comment is like a it's like a staff paper, and it just says, hey, we want to know what do you think the board should focus on in the future, and what shouldn't we focus on? What are we working on that we shouldn't focus on, right? So, and there we did some initial research, and so, looking at requiring greater disaggregation in the financial statements is one that users have talked about for a very long time. Looking at emerging transactions, which, like ESG and cryptocurrency, and then looking at reducing unnecessary complexity and looking at our standard setting process. So just quickly on the next slide, the ITC respondents, there were 500 comment letters. However, 522, however, 445 of those comment letters related to asking the board to look at fair valuing, looking at recognition, measurement, presentation, disclosure, and fair value of cryptocurrency. So, and that was all they talked about. Apparently it was from a tweet from some prominent person who got all these people on board to tell the FASB, hey, this is what you got to do. The other 77 comment letters focused on other issues. So I'm going to move on. We're going to try to finish this feedback up by the end of June. I'm going to move to the slide that says NFP specific feedback on operating measures. As you know, this was a project on our agenda. I think it was like a research agenda for a number of years. However, we didn't get really strong feedback that this was something that we should focus on, looking at some sort of operating measure for NFPs. So the board dropped that. So there are no NFP specific projects on the agenda right now. So I don't know if, can't hear the applause in the background, but, there are other things that could affect NFPs, and that's what we're going to talk about now. But there's nothing that specifically addresses NFP accounting. Again, on consolidation, on the next slide, the consolidation is another issue that was the board is dealing with. There were some calls from the comment letters to say you should take a holistic look at consolidation. However, we really didn't see, like from the not-for-profit side, that there was a huge call for that. So the board decided to add a research project, but focusing on consolidation for business entities. It's kind of a back burner project because there's so many other things that are like higher priority on the agenda that, I think that we, this probably, if it does affect not-for-profit entities, we will focus on that. We will let you know. But right now, that I wouldn't. That's probably not going to be something we're going to be talking about in the really near future. I'm going to skip over our research agenda slide and talk about exchange-traded digital assets, current practice, and issues. So this is a project that was added to the agenda as a result of those 400 and some comment letters. And the problem is, as I said before, that there's an interpretation in GAAP and by the AICPA that says that digital assets are accounted for as intangible assets at cost less impairment, and the impairments are recorded at income and any increases are ignored. And I was jokingly saying the other day that so maybe we don't need to do a project on this because there's probably not going to be any, the increases are probably not non-existent right now, but at least the decreases are there. There might be a lot of impairments right now. But anyway, that aside, the board decided to take up a project to look at recognition and measurement, presentation, and disclosure. And I know a lot of nonprofits are looking at their policies of accepting cryptocurrency. From what we've heard, some are kind of, immediately liquidating them. There might be some that have donor restrictions that are making you keep them in a couple of cases. Mostly people don't seem to be keeping them, but some were looking at crypto as part of their investment strategy, although I'm not sure why at this point, but, there's a lot of issues. So this project's going to really look at this more holistically: recognition, measurement, should it be fair value? How do you present it? How do you disclose it? And there are going to be a lot of issues on how to value it. One thing I wanted to point out is that for non-healthcare NFPs, there's a portfolio-wide fair value option. The guidance isn't clear about whether a crypto would apply or not because it's defined as an intangible, but it is something that we think you might want to look at and consider. So I'm going to skip now to. I'm going to keep skipping. I'm going to go to ESG types of ESG-linked financial instruments. just very briefly, there's going to be a project on the agenda. It's still in kind of the research phase, and that is looking at there are two different types of issues here. One is like ESG-linked financial instruments where the proceeds are linked to an ESG, sort of a green purpose. And then there are other ones that are more accounting related, where there's like if you don't meet your emissions target, your interest rate on this note is going to go up. And so that's where all the accounting issues are, because under GAAP, if you have an embedded derivative in a financial instrument, you have to that's not clearly and closely related. You have to separately account for the derivative at fair value and the debt contract at amortized cost. So the board is looking at, on the next slide, the preliminary leanings of the board are not to sort of separate these out, separate the derivative out from the host contract, and try to think about ways where a lot of stakeholders and users don't like that separation. It leads to a lot of confusion. Many of the financial statement users are preferring disclosures over, this sort of complex accounting, and they don't feel its decision useful. So this is a project that's still, again, on the research agenda, and stay tuned for that. I know that I don't know if the accounting side of this derivative is really like a big issue for you all. I have a few more minutes. I'm going to try, I'm going to plow through. I'll try to finish at 12:05, but I'm probably going to need a few extra minutes if that's okay. And then we have some time for questions. So I hope I don't I hope I don't delay your lunch at all, but I'll try to. I'm getting pretty close, and I'm trying to stay close to time. So the other project that's been added to the agenda is accounting for environmental credit programs. So these are like cap and trade programs where that you have these, maybe certain certain industrial companies would have a pollution target, right? And that was set by the government or by another. And then they would, if they meet that, or if they don't meet that target, if they go under the target, they could sell the difference, the amount that they haven't polluted. They could trade that with another company that won't meet their targets. So these are all the project that's going to be focused on. There's no accounting, there's no U.S. GAAP for this. And so it's going to look at the assets and liabilities that are created by trading these environmental credits, and it's going to focus on renewable energy credits and cap and trade programs, and they're all kind of variations of the same theme. You get to the ones that could be sort of bought and sold. It's also going to look at creators of those, and we know that some not-for-profit entities that we've heard from are creators of these. And so it's going to look at the accounting for those, that if you're a non-governmental creator. So governmental creators are in GASB, non-governmental creators are in FASB. And so stay tuned for this. It's going to be an interesting project. I think that there's going to be some, interesting developments on this. Again, really kind of hot topic right now. Again, there's an accounting for government grants invitation to comments, because again, as I said before, U.S. GAAP doesn't have any guidance on how to account for government grants for business entities. So there's a discussion paper that was issued day before yesterday. So that's why this slide's a little out of date, actually. And the comments are going to be due back in September. And the proposal is to look at whether some of IFRS, the international standard IAS 20, should be incorporated into GAAP. And I'm going to move to the next slide quickly. There are a couple of differences. So, basically, IFRS allows you to net against the expense for business, and so you could present it gross, or you may present it net. And as you know, under GAAP, you have to present the government grant gross. And that's probably, there's some, timing differences, potentially some fair value differences for non-financial assets. But basically, that's the main difference right there, that this net versus gross. And when you have some industries like healthcare that are both in the for-profit space and the non-for-profit space, you might get different accounting answers. So that's something we're going to be looking at. But this is very early days. It's a discussion paper, so it's a staff paper and not a board paper, if you don't know all our processes. So it's really early days, just getting preliminary feedback. And again, it doesn't apply to you anyway, but just something to kind of stay on top of. And then something that's probably of value to you is accounting and disclosure of intangible software overview. So as you know, there's two different models in GAAP: the internal use software for your own internal guidance, and that your own internal software has different guidance from software that you intend to market to customers. And there's different thresholds and different capitalizations. And on the next slide, the feedback on the agenda consultation is that having these two models is really out of date. It's really very old-fashioned, and that it really needs to be updated for how software is developed today. And things like hybrid cloud solutions, where they're partially in cloud and partially software. You use the internal use guidance for the hybrid practice uses the internal use guidance for the cloud piece, and the external use guidance for the software. And so the board's going to decide later this year whether to add a project on this, but it's something that's really, a lot of practitioners and said that this is just really out of date and needs to be updated for the 21st century. So stay tuned on that. And then I think my last official slide before the last polling question is that the goodwill project, identifiable intangible assets and subsequent accounting for goodwill. So you're going to hear this. Some of the people are going to hear this first. There was a board meeting this morning, and the board decided to drop this project, mainly for all the slides, all the tentative leanings, and the next couple of slides actually kind of not relevant right now. I don't know whether, I think they're going to continue to do research on this, but the board decided, I think there were some issues around, whether we were replacing, sort of the model of impairment with another model that was just as complex and not as decision useful. So the board wanted to take kind of a step back and sort of think about what they were going to do on this. And so the board decided to, sort of take the heat off and not continue with the amortization model for business entities. And it's going to take a little bit of a break on this. So, all of this will be released later today. But if you listen to the public board meeting this morning, they talked just before I came on. They decided to drop the active project. So I wasn't clear on whether it's going to be a research project, but I feel like there's going to be, it seemed to me the way the tone was that we would continue to monitor, what the international standard setters were doing and, just kind of stay up on what was happening, but no active attempt to change GAAP at this point. That brings us to the last polling question. So digital assets generally are accounted for as A, goodwill, B, financial assets, C, fixed assets, or D, intangible assets. So I'll give you a couple of seconds to answer that, and then you should have all your CPE in. And I did it. I got through all the slides in 5 minutes. Well, I started late, but I got through them all. How are we doing?
So the last poll results are 73% intangible assets, 14% goodwill, 11% financial assets, and 1% fixed assets.
Okay. So the 73% D intangible assets is correct. Now, whether that will change in the future as a result of the project, remains to be seen. So, are there any questions? Are there any questions for me, or do you want to take those offline?
Jeff, we don't have any here in the room.
Okay.
Do you have any online?
Okay.
Okay.
All right. Well, thank you very much.